Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Hey, welcome to 2023, and I've got 3 incredible tips that I think can help you manage your investments and grow your wealth this year. There are a lot of things that are on the calendar that we know about, and there are tons of things that we have no idea of what's going to happen this year. However, these 3 things can help you to manage your portfolio, manage your emotions, and keep everything on track. So without further ado, let's go ahead and get into it. So the first thing is stay in the game. Stay in the game. I know when the stock market falls, we saw a lot of this last year where you say, hey, look, let me just get out of the stock market and just let things, figure themselves out. And when it does, I'll come back. Well, on paper, that sounds like it makes sense. Emotionally, it definitely sounds like it makes sense. But actually, it does not. From 1990 all the way up to 2020, if you missed the 5 best days during that entire 30 to 31 year period, you missed just 5 days, then you could have missed out on 37% compared to someone who stayed invested the entire time. So think about that. You missed the best 5 days from 1990 to 2020, and you have lost basically 37% gains compared to someone who stayed invested the entire time. If you do that same thing for 25 days, just 25 of the best days between that same period, you could have missed out on 79% gains compared to someone who just stayed invested the entire time. So yes, just stick with it. I know it doesn't sound like the most conventional thing, but the truth is you're not going to know when those best days are going to come. We saw a lot of this in 2020 and sometimes in 2022 where it was the worst day since whatever historic date, 1929, Great Depression, and then it'd be the best days in the last 50 years. Or the best month like we saw in October 2022 where it was the best month in 15 years or so. You are not going to know when exactly to jump in and when exactly to jump out. So the best case is usually to stay invested the entire time. It's not always fun, it's not always the most flashy thing to do, but history has shown us and data has shown us that is the best thing for you to do. Stay invested, don't get out, don't sell off your 401k, don't quit, stay in the game. That is usually going to be the best way to win over the long term. The next thing here is to play offense and defense. And that is because a lot of times, especially if you're new, you go in, you look at the stock market and say, hey, look, I'm buying this stock. I've done my research. I've looked at the charts. I've read everything I can possibly read. The market looks like this, and this is going to be the best investment ever. That makes sense. Okay, I'm somebody who's been doing this for a while, and at no point ever in my life have I sat down, did research, and said this stock is going to lose and still put my money into it. That's not what we do. That's what nobody does that. We put our money and we do our research into things because we think they are going to succeed. However, it doesn't always happen. For example, y'all know I invest in Apple. I invest in Microsoft. That's me playing offense because historically, those have been some of the best companies in the last 2 decades. So odds are they're not going to lose money. But they did. However, that wasn't the only thing that I invested in. So when I say play offense and play defense, choose the stocks that you research and you think are going to continue to do well or do well in 2023 and beyond, but also have those backup plans. For me, the backup plan is still having an emergency fund. You definitely want to have that. But outside of that, I still hold an index fund. An index fund, for those who may not know or who are new subscribers to the channel, that holds entire segments of the stock market. So for example, instead of in 2023, will Apple be one of the top 10 best stocks or not? I don't know. However, I do know that the S&P 500 is 500 companies all in one single investment. So if I'm wrong about Apple, chances are the other 499 companies out there inside of the index fund is probably going to help me out. It's probably going to help me to see better gains or at least smaller losses. So for example, we talked in our most recent video, we were saying that S&P 500 was down 19%, but there were some stocks like Carvana that were down 97%. So playing defense in that case would have been holding an index fund and, cutting your losses on Carvana or something of that nature. So play offense, but also play defense. Never just go so fervently into just one stock and not think about the downsides and not diversify. You definitely want to play defense and say, look, I think it's going to be this company. However, I also own X, Y, Z, and every letter in between, just to kind of balance yourself out and that you're not, putting yourself at risk. One of the other ways that I do this is what I call a 5% rule. I try to have no more than 5% of all my money invested in one particular stock at a time. And that is, again, if you are wrong, what you don't want to do is say, hey, all my money was in that one stock and I lost money, or half my money was in that one stock or that one cryptocurrency and it didn't work. That's the stuff that can set you back years. You don't want to do that. You want to be in a position to benefit if something goes well, but also in a position where you can afford to be wrong. And I've said that before. We're like, hey, some stocks didn't work, right? I invested into it. I had Adobe for years. It's not going to throw me off of my total financial goals, because I did limit myself to how much money I put in. I took a 30% loss in some of those cases. Yeah, it's fine. I still have, playing defense, I still have O'Reilly that was up 67%. Great, right? So I can kind of balance myself out and have a normal return, or at least a solid return, as opposed to playing offense and nothing else. Got it? All right, so the last one here is know exactly what you own and how it plays, or how it's supposed to play in the broader economy or the broader stock market. What I mean by that is this. You want to know exactly what you own in terms of, like, what does the company do? How are they doing it? Are they making money? Are they not making money? And compare that with what is the theme, quote unquote, of the stock market. So, for example, we know in 2022 and perhaps in 2023, but we knew in 2022, we knew that the interest rates were going up. We know inflation was high. Okay, so if I know that, and I know inflation is going up, or I knew inflation was high, and I know interest rates were going up, that means that borrowing money is going to become more expensive. That means companies who need to borrow money are not going to do well. And if you need to borrow money, you probably have a lot of debt. If you probably have a lot of debt, you're probably not profitable. If you're not profitable, you probably lost your customers or something of that nature, right? So that tells me that companies that were relatively new, companies that weren't profitable to begin with, were going to be the ones that suffered the most. But if you don't know that, and you don't know what you're investing in, and you can't compare that to what's going on in the environment, then you're going to lose money. You're not going to know why. If you don't know why you're losing money in the market, then you're not going to know how to fix it, or what to invest in, or how to even react in those situations. So you have to sit down and compare those two things. There's a reason why General Mills, a stock we've talked about before, Smuckers is SJM, a stock that I currently invest in and we've talked about before. Those are companies that made a lot of sense and made a lot of money because people were still eating cereal, people were still eating jellies and jams and all that kind of stuff, and snacks basically for both of those companies. Why did they do well? Well, in an inflationary environment, you can throw Hershey in here too, another company we talked about. They can raise their prices very easily to go from, let's say, a dollar candy bar or a dollar box of cereal. I know cereal isn't that cheap, but in either case, to go from $1 to $1.10, we can stomach that, but that's a 10% increase, and that's 10% increase in revenue. They can adjust those things very quickly, and there are things you have to have in most cases. You got to have food, and they're in that food category. Not really a way to kind of get out of that, whereas a company like, let's say, Zoom, or even Carvana, or even CarMax for that matter, once I have a car, I don't have to come back, right? Also, as supply chains got better, which is another environmental case, more new available cars were out there. It also got more expensive to buy cars because interest rates were going up. I have to know those two things. Now, if you don't know the second half, like, only you can research the stock that you have, right? I can't do it for you because I don't know what you have. But we do cover a lot of these stocks on the channel, so you do want to like and subscribe if you haven't already. Aside from that, though, if you don't know how to figure out what's going on in the broader economy and all the themes of the market, we do talk a lot about that on the channel. So you definitely do want to peruse any of our previous videos. Anytime interest rates change, we talk about it. Anytime it's something with gross domestic product, GDP, we talk about those things. Infrastructure bills, all that stuff we do talk about here, because that is a little harder to match those two things up. Evergreen in economics. That's what I'm here for. So make sure that you are comparing those two. Now, if you need help trying to figure out what I need to look for in terms of investing in a particular stock, like how do I research, I have covered that on the channel before. So just go hit the search bar, Building Bread research. I have at least 3 or 4 videos on how you can learn to research a stock and figure out what exactly it is you want to look for. We also have that inside our members only as well. So those are the 3 things that you have to do. play offense and defense. That's one. I'm combining that one. Stay in the game. Don't sell just because the market drops. And the last one is know exactly what you own and how it fits into the economic environment. How is it going to fit with what is going out here in the world? It's essentially knowing, like, hey, know the weather, right? You don't want to go out here and buy an umbrella in a place that's not raining, right? That's not really going to help you. You definitely don't want to wear a huge Canada Goose coat in the middle of Hawaii in July. You don't know the weather, right? You don't know the environment. These two things do not match. You want to make sure that you have the right stocks for the right environment. Okay, so make sure those two things match. All right, you do those three things, you are going to be okay in 2023. And these tips honestly work in any year, but it's something you definitely have to pay attention to in 2023 because every year is a bit different. What worked in 2020 when it was a pandemic, Zoom, all these Zoom stock, y'all know, the video conferencing app, Peloton, all of that stuff was easy money back then. Every year we get away from the pandemic, things get back to normal, and back to normal was a little bit more difficult. So it's going to cost you a little bit more time researching and a little bit more knowledge in fitting these companies and these stocks into what is going on in the broader environment. To do that, hit the like and subscribe button. This is what we talk about all day, every day. Well, Monday through Fridays, with the exception of, the day the market is closed like it was yesterday. All right, that is it for me. I'll talk to you later.